When people talk about diversification, they'll usually say, don't put all of your eggs in one basket. In the context of investing, the eggs are your money, and the basket is what you're investing in. Depending on what it is, you may be putting yourself in a vulnerable position. For example, if you're only investing in one stock, you're exposing your entire investment to the performance of that one stock. You may find your account has big swings, and there's no guarantee that you'll make any money. For instance, a company can have a record-breaking run of profits for 30 years straight. But then a competitor comes out with a new technology that completely disrupts the entire industry. Just because a company does well in the past, it doesn't mean it will continue to do well in the future. By splitting your eggs into multiple baskets, you can help reduce the risk you take on. Basically, the goal is to spread risk among different investments while trying to keep as much upside performance as possible. That's diversification in a nutshell. If this sounds weird, there's another way to look at it. We actually diversify in many ways, in all walks of life, to reduce risk, like shopping around to get the best price or service. Or when buying a car, we don't just rely on seatbelts and airbags. We might actually opt for the lane departure warning and other safety features to lower the risk of personal injury. We also diversify when it comes to healthy eating, making sure we eat across different food groups to help ensure we have energy and a balanced diet. What if you bought several stocks, but they all share a similar profile, like they're all financial stocks with banks and insurance companies? This is more diversified than being invested in a single stock. But if there was news that negatively affected all financial companies, then all your investments would be impacted. Now, what if your money was invested into a mix of different Canadian stocks across different industries? This is moving in the right direction, but what if Canada fell into a recession? Most of these stocks would likely be negatively impacted, but if you had spread your money into investments in multiple geographic regions, then there would be a lower risk. Now, how do we diversify when it comes to investing? A common way is through something called asset allocation. We'll get into that in another video.